You didn't just watch silver go up this week, you watched it snap. Price blasted through the 90s like that level didn't exist then, in the middle of the session. It whipped so violently that if you were staring at the chart, you probably felt that sick drop in your stomach. The kind that makes traders hit the sell button just to stop the pain. But here's what makes this move different from the usual hype cycle. That brutal dip didn't end the rally. It tested it, and the market kept pushing. So the real question isn't, did silver pump? The real question is, are we still in the acceleration phase, or are we staring at the start of a blow-off top? Because the next price level traders are debating is not 95, not 100, it's the 106. And when a market starts circulating a clean, headline-friendly number like that, you already know what shows up next: FOMO money. Now, quick housekeeping because it matters. There are a lot of recycled voices in this space. Same charts, same talking points, different thumbnails. If you respect original analysis, drop a comment with G-Crew so I know you're here for real work, not copy-paste noise, all right? In this video, I'm going to break down what actually happened in the move through the 90s, why 106, the next big magnet level, and why that number is emotionally dangerous, the two most likely paths after we get there, what could go wrong fast, margin, leverage flushes, fake breakdown, traps, and what gold, platinum, and the stock market are quietly implying, because silver doesn't move in isolation, and near the end, I'll show you the one behavior that often separates a sustainable rally from a final, exhausting top. Let's get into it. Silver has been pressurizing for a long time. Months of coiling, chopping, frustrating both bulls and bears. Then 2025 flipped the switch. Momentum didn't drift in, it rushed in. Volume expanded, participation widened, and silver stopped being the metal people talk about someday and became the metal people suddenly wanted right now. You can see it in real life. New buyers asking basic questions like, where do I buy? People who ignored metals for years suddenly watching intraday candles, and even the skeptics switching from mocking it to asking, wait, did I miss it? That's the exact environment where charts become both powerful and dangerous, because the chart doesn't care about your beliefs, your politics, your favorite influencer, or your emotions. It only cares about price behavior. Now, let's talk about that stomach drop moment, the intraday flush. When a market is trending normally, pullbacks feel like speed bumps. But when a market enters expansion mode, like silver, pullbacks feel like trapdoors. And this is important: a violent drop isn't automatically bearish. Sometimes it's the market doing a very specific job, shaking out weak hands and checking whether demand is real. So here's the key question after the flush. Did price stay broken, or did buyers step back in and reclaim ground? Because that difference tells you whether the move is fragile or whether it's being defended. And what we just watched looked a lot like defense. Not calm defense, not polite defense, but that aggressive, you're not getting this cheap kind of defense. That's often what happens right before the next leg higher, especially in a market like silver, where leverage and emotion are always sitting right under the surface. Which brings us to the level everyone's whispering about next. Let's map this in a way that isn't mystical. A lot of traders are using extension tools, Fibonacci extensions, measured moves, impulse projections, call it whatever you want. The point isn't magic. The point is that markets often repeat expansion patterns because humans repeat behavior. Here's the clean version. Silver launches in an impulse move. It peaks, it pulls back to a clear swing low, then traders project the next expansion zone. Two levels tend to matter most in these setups. A first extension zone that acts like turbulence, and the full measured move zone that acts like a psychological milestone. That full measured move zone is landing around 1,106 to 107 depending on the feed. And here's why that matters beyond charts. 106 isn't just a number. It's a headline number. It's the type of level that triggers. Silver hits new record highs, posts mainstream attention, late money, and the worst kind of buying, emotional buying. Now let's talk about the trap. Imagine someone sold at 90 because they felt smart then. Price hits 977, they feel slightly uncomfortable. Then a 102. Now they're annoyed. Then 106 flashes on the screen. That's when the brain stops thinking in probabilities and starts thinking in pain avoidance. I have to get back in. That is pure FOMO. And FOMO near a major projected target often creates one of two outcomes. Either a sharp continuation spikes, because everyone piles in at once, or violent reversals, because the market runs out of fresh buyers, and sometimes the third outcome, honestly the most common, is a nasty sideways chop that destroys impatient traders without giving anyone the clean entry they want. So no, this isn't me saying 106 is guaranteed. Nothing is guaranteed. Markets owe us nothing. This is analysis, not financial advice. But it is the next major level where behavior matters. And the most important question isn't, will we hit 106? It's what happens after 106, if and when it gets tagged. Let's separate this into two scenarios. Scenario A is in tag 106, cool off, build, continue. This is the pause, then higher story. Silver runs to the target zone, then stops acting manic. Volatility cools, price builds a range. Higher lows form. The market digests gains instead of collapsing. That kind of behavior is often constructive because it builds a base for the next push. maybe toward 115, 120, or beyond over time. In that scenario, 106 isn't the finish line, it's an intermission. Scenario B tag 106 to blow off behavior breakdown. This is the peak, then give it back story. Silver hits the level, sentiment gets euphoric, everyone starts posting moon targets, leverage piles in, then the chart begins failing to hold key supports. And here's where silver is ruthless. Mean reversion in silver can be brutal. History doesn't repeat perfectly, but it rhymes. Big silver spikes have ended with drawdowns that are not cute 50%, 60%, even 70%. That's not doom talk. That's what happens when a crowded leverage trade unwinds. Now do the math. If silver hits about 160, a 50-cent retrace brings you near 53, a 60% retrace brings you near 42, and notice how those zones also line up with major breakout prior resistance areas that markets love to revisit. That's why having a plan matters. Not because you have to sell everything, not because you have to become a day trader, but because parabolic markets punish complacency. The fast damage triggers. Watch these. Here are the fastest ways silver wrecks people during a hot run. Margin requirement hikes. Exchanges raise requirements to reduce risk. That forces leverage traders to cut positions. Forced selling creates sudden air pockets. Thin liquidity moments when the order book isn't deep. One aggressive wave can drop price hard. Emotion-based entries buying because who's running without knowing where you're wrong. So here's the healthiest mindset you can trim into strength. You can rebalance. You can keep a core position if you're long-term bullish. But you do not want to ride a vertical move all the way up and all the way down just to say you held. Because the only thing you can't buy back is time. And while everyone is hypnotized by silver, we need to talk about what the other markets are saying, because that's where clues hide. The bigger map behind silver is loud, gold is quiet. And quiet is where serious money hides. Gold doesn't usually swing like silver. It trends in a steadier way, which is why it often acts like a macro fear gauge. On many traders' projections, gold has a target zone building in the low 5,000s, roughly 550 to 250 depending on the structure you're measuring. That doesn't sound as exciting as silver, but in gold terms that's meaningful. And here's the part people forget: even gold can drop hard during a true unwind. In major deleveraging events, correlations can snap toward one, meaning stocks fall, metals fall, crypto falls, and everyone suddenly wants liquidity, so gold can still see sharp corrections, even 25% to 35%, not because gold failed, but because forced selling hits everything. Now let's talk platinum. Platinum is the metal that loves to surprise people. Quiet for years, then suddenly explosive when it catches a bid. Depending on the swing being measured, some projections point toward a zone in the mid-3,600s, around 3,600, 368 UF. Platinum tends to move differently than gold and silver, but in metals together environments it can run in sync. When that happens, it often signals a broader commodity repricing cycle, not just one metal having a moment. What about the stock market? Stocks still look bullish structurally in many views, but they also feel stretched. You know the vibe, everyone's confident until the first real crack shows up. It's possible equities grind higher a bit more. Another few percent, maybe more, because institutions still buy dips in momentum regimes. But when that buy, the dip behavior stops working, the shift is violent. You go from every dip is a gift to why isn't it bouncing? That's when people realize safety isn't guaranteed anywhere. And that's why I keep saying metals are not moving in a vacuum. They're moving inside an ecosystem where liquidity, risk appetite, and leverage decide what gets repriced next. Now let's get to the key part, the signal that often reveals whether silver is still rallying or starting to top. Here's the behavior that matters most near a major target like 106. Does the market accept higher prices or reject them? That sounds simple, but it shows up very clearly on the chart through structure. What, acceptance? Often looks like price reaches the target zone and doesn't instantly collapse. Pullbacks become controlled, higher lows keep forming, volume expands on pushes up, and contracts on pullbacks, breakouts hold instead of instantly failing. That's how a market tells you we're building above this level. What, rejection? Often looks like price spikes into the level fast. Mania candles, volatility expands and stays expanded. Big wicks show up repeatedly. Attempts higher get slapped down, so support levels start breaking and aren't reclaimed. Pullbacks don't bounce cleanly. That's how a market tells you we ran out of buyers up here. The three simple signals I'd watch right after 106. You don't need to be a chart wizard. Just watch these. Support, respect, identify the last clean support zone before the final push. If silver starts losing it and can't reclaim it, that's a warning. Volume behavior, healthy trend. Volume pushes on rallies, fades on pullbacks. Distribution, volume spikes on down candles and bounces look weak. The shape of the range, tight range, the higher lows, often bullish digestion, wide choppy range, the failed bounces to often distribution. And here's a psychological truth. The most dangerous moment isn't the dip. It's the moment after the big number prints, when people relax and assume it's safe now. That's when leverage increases. That's when late buyers chase. That's when the market has the maximum ability to punish. So whatever you believe about silver long term, don't confuse excitement with a plan. Now let's turn this into a practical game plan depending on what kind of participant you are. Let's make this usable. If you're a long-term holder, your job isn't to trade every candle. Your job is to avoid self-sabotage. Know this going in. 20% pullbacks in silver are normal, 40% pullbacks are painful, 60% pullbacks are where most people quit at the worst possible time, so you don't need perfect timing. You need emotional preparation and position sizing that won't force you into panic decisions. A lot of long-term winners do something boring but effective: keep a core position, trim a portion into strength near major targets, rebuild on consolidation or confirmed pullbacks. That's not weakness. That's survival. If you're a short-term trader, active investor, you need one non-negotiable rule: always know where you're wrong before you enter. If you don't know your invalidation level, you don't have a trade, you have hope. Also, don't confuse missing the move with needing to chase. If silver runs to 106 and you're late, the worst move is buying because your emotions got loud. The better move is waiting for a pullback into support, or a base to form, or a breakout that holds confirmation over prediction. You'll never catch the exact bottom, but you can catch the most important part, the middle. Quick recap so you leave with clarity: silver broke through the 90s with aggressive momentum. The violent intraday flush was not automatically bearish. Recovery matters. The next major magnet level traders are watching is around 106. After 106, the market typically chooses between consolidation and continuation, or topping behavior and sharp mean reversion. Gold and platinum matter because metals often rotate together. Stocks still have momentum, but that sell leverage makes everything fragile. The tell near the top is acceptance, rejection at higher prices. Now I want to ask you two questions. Answer honestly. If silver hits 106 and drops 20% in a week, what would you do? Hold, trim, buy more, panic sell? Be real. If you could only hold one metal for the next year, gold or silver, what do you pick and why? If you want more updates like this, subscribe and turn on notifications. Because when markets move like this, the window is small and the whipsaws are fast. And remember, the market doesn't pay you for being right. It pays you for managing risk while you're right. That's the difference between a great trade and a great lesson.